Why should I care about GDP, CPI, and unemployment when I just want my stocks to go up?
Because these reports move markets. They tell you if the economy is speeding up or slowing down, which directly affects company profits and stock prices.
So which one should I watch first if I only have 5 minutes a week?
Start with the unemployment report, called the jobs report. It comes out monthly and often triggers big market swings. It shows how many people got hired and what wages are doing.
Got it. But what does a strong jobs number actually mean for my portfolio?
Strong hiring usually means consumers spend more, boosting company earnings. But if wages rise too fast, inflation fears grow, and the Fed may hike rates, which can hurt growth stocks.
And what about CPI? I hear that term everywhere. Is it just about groceries and gas?
CPI measures the average price change for a basket of goods. High CPI means inflation, which erodes purchasing power. For stocks, moderate inflation is fine, but hot CPI often triggers sell-offs.
So if CPI comes in high, should I sell everything and hide in cash?
No. Instead, think about which sectors benefit. Energy, materials, and value stocks often do better during inflation. Tech and long-duration bonds tend to struggle. It's about rotation, not panic.
Okay, now what about GDP? That seems like the big headline number.
GDP is the total value of everything produced. It's a lagging indicator, so it tells you where we've been. 2 straight quarters of negative GDP means recession, which usually drags stocks down.
Are there any early warning signs I can watch before GDP turns negative?
Yes, watch the yield curve and PMI. The yield curve inverts before most recessions, and PMI, a manufacturing survey, drops below 50 when factories slow down. Both lead GDP by months.
So if the yield curve inverts, should I dump my stocks immediately?
No. Inversions happen months before recessions, and stocks often rally for a while after. But it's a signal to trim risk, hold quality companies, and keep some cash ready to buy dips.
What's the single most practical thing a beginner investor should do with all this data?
Don't trade on every headline. Instead, build a diversified portfolio, check the monthly jobs report and CPI for big surprises, and rebalance once a year. That's how professionals use indicators without overreacting.
So the real takeaway is to stay calm and use these reports as context, not triggers?
Exactly. Economic indicators help you understand the weather, but you still need a solid ship. Focus on your time horizon, keep costs low, and let the data guide your risk level, not your daily trades.